very good evening. Thank you for joining us here. You're watching News Now and I'm Nivedna Prabhu. Clearly our focus, the AMFI data for the month of June has trickled in. The SIP inflows has touched an all-time high of 27,269 crores. Now flexi cap funds emerged as the most preferred option for investors, bringing in rupees 5,733 crore in June. That is compared to rupees 3,841 crores in the month of May. This in fact marked a 49% month-on-month rise. Now, small cap and mid cap funds also continue to attract strong investor interest. But my colleague Sharad is here with all the highlights. Sharad, very good evening. Tell us more.
Well, a very strong AMFI numbers coming in for the month of June, and the first time itself the number has gone past the 27,000 crore mark, indicating a strong retail participation in the markets despite the volatility we have seen over the last 3 to 4 odd months. Now, interestingly, the equity inflow that has come in at 2-month high levels as well. Last month it was below 20,000 crore mark, and now it's back to the average of almost 24,000 to 28,000 crores, which we have seen over the last 6 months. Interestingly, the inflows, be it the large cap, be it the mid cap, be it the small cap, all are roaring in. Between 30 to 35% month-on-month jump has also been there. Except ELS scheme, all the equity schemes have shown inflows, and this is the 52nd straight month where we are seeing equity inflows coming in strong. Also, apart from this, if you look at it, the debt numbers have also been decent, but the most important number to look out is the SIP number. It's at a record level of 27,000 crore odd rupees. So that's a very strong indication coming in the markets, especially regarding the AMC stocks as well as the mutual fund data. And overall, the sentiment is back.
All right, Sharad, thank you for joining us with those inputs and putting that into perspective for our viewers. But let me carry forward that number and, of course, insights as to how they're also looking at this, being joined in by both my guests this evening, Feroze Azeez, Joint CEO, Anand Rathi Wealth Limited, and Sunil Subramaniam, Market Expert. Good evening to the both of you. Thank you very much for taking the time out and joining us here this evening on ET Now. Mr. Subramaniam, let me begin with you. Strong June data. We just heard what my colleague Sharad had to say, with equity inflows surging past 23,000 crore and SIP is in fact crossing the 27,000 crore for the first time. It's a record number data, but how do you read into this to begin with?
So 2-3 things here. So first is that it's heartening to see the continued faith in small and mid cap. And I suspect a lot of that is through the SIP route. Right. And 2 things. So if you remember a few months ago, there were some senior AMC officials saying that beware of mid and small caps in terms of this, stop your SIPs there. I think it's a strong reinforcement that by and large the distributors have ignored that kind of thing and stuck to the long-term goal planning and building up the SIP book. Second is, it's been also common knowledge. Yes, over the last 6 months, large caps have outperformed mid and small caps, but the distributors, keeping the long term in mind, have continued to promote those schemes. And what's heartening to see after last month's slide tip is that the flexi cap, small cap, mid cap, and large and mid cap, these schemes have seen great inflows, which means that the people are giving the money to the fund managers to make the right asset allocation. Right. And the final point I want to stress is that while this is a reinforcement of people's belief in India's growth story, the NDA government, but also the fact that it is a self-fulfilling prophecy, because it is the almost 4 lakh crores of mutual fund inflows from the beginning of the year, which have protected the market from the FII volatility. And that has reinforced confidence because people have not seen a massive erosion in their AUMs because of this. And so their confidence that continues staying invested from your goal planning towards an SIP route is get reinforced. So I see that as a very healthy sign that domestic flows through mutual funds will continue to counter the FII volatility in the coming months. And with the Trump tariff and all of that natak going on, I think this is the greatest reinforcement that there could be a bottom for the market. The market won't fall very much because any sharp correction, fund managers have the ammunition to go and buy select stock sectors which are becoming cheaper. So I think it's a very good, like I said, self-fulfilling prophecy that it assures a stable, maybe consolidating market, but a stable outlook for the market because of this inflows coming in strongly.
Right, Mr. Subramaniam. Given how you have read into it that there's belief in India's growth story, there is, of course, a strong faith, and essentially what we're looking at in terms of those numbers. You also spoke about that Trump natak. We're looking at tariffs. We'll, of course, speak about that as well. But Feroze, how do you look at it, given the aspect of how Mr. Subramaniam also put that into perspective at the moment? Do you agree?
Nivedita, to my mind. One is what I see again one trend, of course, like Sunil Saab rightly pointed, the Indian retail has shown faith. Earlier, 5 years back or 7 years back, more particularly, if the markets didn't deliver for 3-4 months, the SIP numbers would drop 20%. But here, on the contrary, you have gone through a reasonable amount of volatility start January, but the SIP numbers have gone up. That doesn't happen. October 21 to October 23, this was 2 years of lull period, 18,500 Nifty and back to 18,500 Nifty, but the SIP number went from 11,000 to almost 19,000 crores, which implies that Indian retail has stopped seeing SIPs as an investment vehicle, but a savings vehicle. That's the greatest news, and that's the hypothesis. So the rate at which, when we look at, we also have a SaaS business where we have several, more than a lakh users as end users. The number of people now opening the app to see the values has dramatically reduced in the last 3-4 years. That means people are not looking at investments, they're looking at savings. But the HNI, on the contrary, ironically, again last month, has redeemed a lump sum amount is minus 4,000 crores. If 77,000 crores has come in the form of SIP, but the net flow in equity is 23,000 crores, which implies 4,000 crores has mota moti gone out. That's a simplistic way of measuring it. HNIs have always been selling when it's time to buy, and vice versa. So I think Indian retail has become sharper than Indian HNI, who's trying to time the market and getting too perturbed because their values are larger. They get perturbed by what Trump is doing, what wars are happening, and they exit and sit on the sidelines, and they lose a lot of value in the process. So that's the second point I would want to make. The third small point I would want to make, 10 years back, the industry was 12 lakh crores. Today, the largest player, which is SBI, is 12 lakh crores. And we are almost headed towards $1 trillion industry. 74 lakh crores is what the mutual fund industry has become in the month of June from 72 lakh crores last month. So I wouldn't be surprised if we get to 86 lakh crores and we can call ourselves a $1 trillion mutual fund industry. So 10 years the full industry is the largest player now. So if that were to happen, I think we'll be a $4-5 trillion industry in the next 5 years, in another 10 years.
Absolutely, and perhaps we could all rejig again to discuss that particular story as well. But both of you happen to point out about one thing that everyone's currently, of course, talking about, the tariffs. So, Feroze, let me take that back to you. Given the strong domestic backdrop and the numbers that we put into perspective as well, will global risk events like Trump's, with the deadline as well, August 1st, threat override the local momentum, in your opinion?
I think any global fallout, other than one of the risks, I see one, the trade war, all these are not big risks. To my mind, these are going to be buying opportunities. Why do I say that? From FY21, after the COVID year, when the COVID was in peak and we were all sitting in lockdown, after that year, FIIs have given a net flow of near zero to India. They added some money, they subtracted some money, they are net zero. In the same period of 4 years and 1 quarter, that's 4.25 years, Indian domestic institutions, you would be surprised if you sum total it, they have added 14.5 lakh crores. 14.5 lakh crores. The preceding 8 years, the DIIs only added 2 lakh crores. So 25,000 crores per month before COVID, and after COVID, 3.5 lakh crores per year. Sorry, both are per year numbers. So we have added 14.5 lakh crores. My estimate is minimum 50 lakh crores will be added by domestic institutions in Indian equities, is the estimate. So I personally think any short-term corrections from a global side will be a buying opportunity, except one thing. How will US solve its debt crisis and how will it bring down the balance sheet? Fed has about 6.5-year papers in their balance sheet. So Q tapering, how will they do quantitative tapering is what I think is the most important risk from a medium-term standpoint globally.
All right, so that is factoring in how that will pan out. But Mr. Subramaniam, you would want to come in on that and essentially how you were also looking at this, given the deadline's also August 1st now and overriding the local momentum? Or do you differ?
No, I see that this is as a glass half full, half empty situation because our markets have done what they have done without FIS support. But you can't assume that FIIs will not support us, right? It's just because the situation was not favorable because of various happenings that FIIs have been very volatile vis-a-vis India. But once the present level of the Trump tariff tantrums settling down, which I would suspect should end by about Christmas, okay, and the American exceptionalism will come to an end. What do I mean by that? America is 30% of the world's GDP, but has 70% of the world's market capitalization. So one of the reasons India has suffered from an FII perspective because money has tended to chase what was seen to be a risk-free market in America. And, money is saying if I make a good, decent return there with the dollar then strengthening, it made eminent sense not to take risk in emerging markets. But since then, what have we seen? We've seen America downgraded. We've seen that the dollar has started to weaken. And so what Feroze suggested in terms of the fact that how America is going to manage the debt crisis, the tariff is one of the ways I think Trump is seeking to do that. Because on a $3 trillion import for the US economy, a 20% on an average tariff would mean $600 billion per year, which for money inflow. I think though this is not come in the public domain, I believe that Mr. Trump as a businessman, I view him as a chief business officer of America rather than as the president of America, is probably trying to solve that also through this because the tariffs provide income to the American government. And you've seen that despite all this uncertainty, American growth has been fairly decent. Yes, inflation is not coming down. That's a different point of view. So why I'm saying this is I see that the monetary flows starting to shift away from America, which is I see that 70% trailing towards the 30. It's not going to happen overnight, but even if 70 comes to 60, that's 10% of the flows, right, which has to shift. And within the emerging market pack, India is the fastest growing country by a distance, right? I think China is nearest at about 4. So I think growth capitals from FIS should start coming back to India once this situation stabilizes as far as the tariff and the uncertainty is concerned. When that comes, along with the domestic support, so far the domestic flows have managed to keep the markets in the green and prevent any sharp reaction to Indo-Pak war or tariffonomics or anything. But once the FII flows start coming back to India, I think the markets will rapidly rise to a new high because domestic flows are going to continue. So I think we are at a tipping point from that point of view. And I would say that when we get a decisive, and you see domestic numbers for this year from an economy perspective have been very good. GST numbers have been growing. The PMI number is at a 14-month high. The monsoon outlook is favorable. The fiscal policy has been supportive with 100,000 crores of giveaways to the middle class. The RBI has been more than supportive with the dividend, with rate cuts, with the CRR cut. So I think that everything is geared to make the domestic economy strong. And once we have a BTA in place where some of the uncertainty around the tariff goes away, I would say that foreign money, FII money should return to India in a big way. And this is not just hedge funds, but growth capital in the form of pension funds and sovereign wealth funds. When they come in, right, the only thing is India is not still cheap. I think the Nifty is still trading at a 21.7, mid and small caps are trading at 27. So clearly way above long-term averages. So the earnings season has to come and justify these valuations. If that happens over the next 2 quarters, I think the FII money coming in would make sure that those levels that we saw last September in terms of valuations, if they return, Nifty should be easily hitting all-time highs, which I think by the end of the financial year is not out of the realm. So I see this as a glass half full. Anything moving,
and that,
money
of course,
moving
is yet another wait and watch game, right? Absolutely. And as you point that out and put that into perspective, Feroze, getting in a word from you, given how we put that into context. This is, of course, a wait and watch game. We're also waiting to see how that's going to pan out. But the market clearly has discounted what Trump has said, essentially since April 2nd. But given what he said recently, the extra 10% about BRICS countries, how do you look at that, at a bigger impact that is?
That's all who blinks past, what kind of negotiations tactics, some degree of bullying, right? Pharma at 200, copper at 50. Every day you hear a little numbers being thrown around. So I think that's all very rightly so. If some people are negotiating right in the public, that is going to be the case. So I personally would wait till the whole thing shapes up. The mini deal is almost there. There is some disagreements on agri and dairy. Textile as a sector will get a benefit from it, in my opinion, because we have a long way to go. Copper, we are the third largest exporter to the US. So that's going to have some impact if that 50% number happens. That's why you saw some metal stock pressure today. So I personally think I would want this to unfold. Basically, what happens is whenever there's a new variable, the market, the frothy ownership suddenly quits. That's why you would see a April 7th happening. Any investor who has come in from a short-term standpoint and is trying to play momentum, suddenly if some news like this Trump gave us the Liberation Day, the markets fell 1,500 points and recovered in India. So that's the frothy ownership which suddenly gets a jolt and is out. So after that, the owners who are there owning the stocks are a little more solid. They're not just the froth. So I personally think that's why you would see solidity there, and that's how discounting of any news happens in the market. So I personally think I'm not too worried, and I would not even want to second guess it. I would want this whole thing to unravel and then try and see which sectors will have a benefit, which will be a detriment. How does a fund manager position to capitalize? Like I said, textile, I'm very bullish. If whatever you do, I think there will be a huge potential for the textile sector, apparel sector to capitalize on the US market, and that can only go up from where it is.
All right, Feroze, as you make that point, if and when these tariffs do kick in, that is, sectorally, who gets hit the hardest in your opinion? Are metals and pharma already vulnerable?
Is that for me?
Yes, Feroze.
Yes. So I think metal is a high beta sector. So metal will find its reasons to go up and go down significantly. But I think metals has a large potential of being hit harder. Pharma, I don't think at all, because if you look at the kind of pharma 200% tariff which was thrown on the generic drugs possible, I think that's definitely a negotiating tactic, because 90% of the medical in the US is government spending. And that's like left pocket to right pocket. So it's not going to help by creating something so substantive on the pharma side. Pharma as a sector has delivered about 28.5% earnings growth last year. The Nifty Pharma has 20 stocks. It has almost about 7% Nifty weight and about 5% NSE 500 weight. It is a lower representation with a free float on the Nifty Pharma of only about 46.8%. I personally think pharma will go through no substantive corrections, and I think structurally you will be benefiting. And I think Nifty Pharma can beat Nifty over a compounded basis for the next 3 years by about 3 to 4%.
All right. And as you point that out, Mr. Subramaniam, did you want to make a point about that as well?
No, what I was saying was that, see, the pharma is a beautifully diversified sector across the healthcare in India, diagnostics, hospitals, domestic sales, the generic pack and the CDMO pack, right? So, but the pharma index tends to react to that news. But domestic oriented pharma shouldn't get. So you will get buying opportunities because it's well diversified across domestic and exports. So I agree with Feroze there that pharma, to me, will be a buy on dips, because clearly the uncertainty till August 1st could lead to some pressure on the pharma space. But those are the good buy on dips for me. And I would look beyond just the Nifty Pharma. You can do a broader base there, because a lot of the domestic oriented pharma are not really in the index. So to that extent, I would say broaden your picks, buy it on dips, and I think it has a good future, because even domestically with the penetration of health insurance, you will see pharma, diagnostics and healthcare and hospitals all going up. So it's a good sector to buy into. So I agree there with Feroze.
All right. And Mr. Subramaniam, as you pointed out, of course, the domestic market is strong. But in the larger aspect of this, how are you looking at what will happen to the fiscal deficit of the country, if you were to put that into perspective?
So I think that there's no reason to worry about the fiscal deficit, because If you see the impact of the RBI dividend, I think that 2.75 lakh crore was an unexpected one, way above the budgeted number. So that's come in as a help. GST collections have been coming at double-digit numbers over the year. So those means that indirect tax collections will come and help the fiscal. And the third aspect is that from a India perspective, right, the growth numbers, I think, will come in better than what was projected at that time. The tariff impact at worst case was at about 10 to 20 or 30 basis points of GDP. So on a nominal GDP growth, if you do at 10%, you would think, I think the fiscal deficit is not a cause for worry. This government has displayed its prudence, and they do have the lever of capital expenditure, which they can titrate it up or down depending on the way fiscal goes. But I see them coming in with a fiscal deficit number better than what they're projected in the budget, because reinforcing foreign rating agencies and FII's confidence in India and FDI, I think is very critical. So we are very conscious of that. So I would rest at ease any worries about the fiscal deficit in India, especially since there's no big election during the rest of the year where a populist spending will get any boost or anything like that. So I'll be comfortable. I'm not worried about the Indian macro numbers. Low inflation is going to help. Interest rates coming down will make the government's borrowing costs also come down. So I can go on listing the positives from an Indian fisc perspective.
All right. The other aspect, since you've been talking about that in terms of the positive story, but Feroze, let me get in a word from you as far as what the numbers that we looked at, right? About 25 to 34% jump in small and mid-cap fund flows. What does that reflect in your opinion? The factors as well.
Now, you see, it reflects consistency, small and mid-cap, 34% jump in the number. See, like 3,000 to 4,000 crores per month coming in into small cap, that has not bat an eyelid at all. Like there has been fears of small cap valuations, but in spite of that, 4,000 crores. Now, how I see that number is, why is 4,000 crores coming? If somebody is surprised, yeah, if there is 25,000 crores coming in the month, why won't 16, 17% go into small cap? If I'm allocating my portfolio, won't I at least put 15% in small cap? I'm not buying 80% small cap. So out of 24,000 crores of net flow in equity, 4,000 crores is a reasonable number. One, what I see from that number is people are investing more sensibly, not investing on the basis of past performance alone, which was the biggest bimari Indian retail had. Past performance is the only indicator of where they put money. Now that is changing, is point one. Point two, the allocations at an industry level, or if you have 40 lakh crores of total equity mutual funds out of your 74 lakh crores, including index funds, what is the proportion of small cap funds? It's about 2,70,000 crores or 80,000 crores in the form of AUM. Is that a fair proportion if all the money of India belong to one person? Is that overly skewed towards small cap stocks? The answer is no. That's point two. Point three, India, when they use the word small cap, India's small cap was also finished in the top 500. SEBI has clearly mandated, forget the 2,300 stocks, forget the bottom 1,800. The fund manager's tier 1 index is large cap is 100, top 100. The subsequent ones are 150 are mid caps tier 1 index. The subsequent 250 are small caps tier index. So पूरे 250-500 company में small, mid, large सब खत्म हो जाता है. So small as a word indicates to a retail guy that is too small a company. But the 500 company in NSE 500 is also called a small cap fund company, in spite of having more than 2,000 listed and traded stocks.
All right. And so essentially you're saying that India is continuing to invest smartly, and that's perhaps a key takeaway as well. But before I let the both of you go, Mr. Subramaniam, what's the near-term outlook? Can small and mid-cap funds sustain current inflow momentum according to you?
See, the inflow momentum should continue, but from a returns perspective, right, I think the earnings season, because what is factored in the valuations is a much higher growth rate for small and mid cap. And the concentration of small and mid caps to the domestic industrials is very high. So to me, the revival of the private sector capex cycle is the one which will lead to these valuations being justified and in fact healthy returns coming through. So I think the capital goods cycle has to recover. Once you see green shoots there, I would say these valuations of 27 are not difficult to achieve, right? Because that's the concentration of the portfolio is around the industrial pack in the smaller part of the market, right? That's one. Second is that if you take the overall market cap, I spoke about individual valuations. If you take overall market cap to GDP ratio, we are at 127% now. And average 10-year is 84. So it will look like they're way overvalued. But last September, we were at 145%. So 145% we have come down to 127. So I'm saying that that euphoric period can again happen, and for 127 to go with some bit of increase in earnings to 145, which is when we'll need to start getting worried whether the next correction cycle is going to start. So until then, I see that there will be a good ride in terms of the return. So I would say keep watch on these valuations. They're approaching 140% plus of GDP. That's when you say, oh, do I need to then take a call on the valuation? But right now, I would say that it's the growth with earnings growth which has to come and justify the valuation. So wait and watch for the earnings season.
Absolutely, and that's perhaps the right way to summarize this conversation as well. We'll have to play the wait and watch game to see how that pans out. But Feroze, Mr. Subramaniam, thank you very much for taking the time out, joining us here this evening, sharing with us your perspective as well. But for the moment, that's all the time that I have on this edition of News Now. But it's a wrap from me on this edition. Stay tuned, lots more coming up on the other side.